The Ondas Holdings stock, NASDAQ ONDS, is currently trading at $5.8564, showing a slight dip of negative 0.23% today as of 12:04 p.m. Eastern Time. This movement is a minor drift within a volatile day, but if you're watching the ticker, you're likely seeing the stock essentially flatlining after a morning of wider swings. The general market expectation, the surface-level narrative, is that Ondas is a small-cap play in the crowded autonomous systems and wireless connectivity space, a company whose valuation has run up massively, over 600% in the last year, but one that remains non-profitable and relies heavily on capital raises and acquisition integration to push its growth story forward. The conventional wisdom is that ONDS is a high-risk, high-reward bet on future government and critical infrastructure contracts, often lumped in with other speculative defense tech and drone stocks. However, the deeper reality that the market may not fully appreciate is not just the sheer number of acquisitions, but the specific, calculated focus of the most recent ones, and how they immediately and materially impact their backlog and near-term revenue visibility, especially in the context of global defense spending. This isn't just a conglomerate of unrelated drone startups. Their move to acquire Centriox, an Israeli company specializing in counter-UAS cyber technology, is a precise tactical maneuver that instantly elevates Ondas from a general autonomous platform provider to a specialist in a high-demand, high-margin, and geopolitically sensitive security niche. Centriox technology, which uses proprietary cyber-over-RF to detect, identify, and take control of hostile drones without jamming or collateral interference, is already deployed in over 25 countries. This acquisition doesn't just add a product, it adds field-proven, combat-ready credibility and an international sales channel that bypasses the typically slow U.S. government procurement cycle for certain foreign deployments. This immediate access to international defense budgets and a critical piece of the counter-drone puzzle is the insight that should force anyone looking at this investment to rethink the risk-reward calculation, particularly as we head into their November 13th earnings report. The expectation is that the losses will continue, but the reality is that the quality of the revenue and the strategic placement of the company are shifting dramatically. Looking closer at the recent stock movement, the intraday high today near $6.10 and the low near $5.76 show the stock remains highly volatile, moving on high volume. We've seen over 25 million shares trade hands by midday, a massive figure compared to its average. This points to a significant level of both retail and institutional churning ahead of the upcoming earnings release. The price action over the past 2 weeks has been characterized by sharp spikes on acquisition news, like the Centriox deal, which caused an 11% pre-market surge, followed by gradual consolidation and selling pressure. The market is digesting two contrasting signals: the genuine excitement over strategic contract wins and acquisitions that validate their technology, and the underlying financial pressure that necessitates frequent capital raising, such as the recently filed $5.6 million shelf registration for new common stock. This capital raise, while a sensible tool for a growth-focused company, introduces dilution risk, which naturally pressures the individual brokerage accounts of existing shareholders. The tension between growth and dilution is the core reason for the choppy trading. Institutional activity provides a further layer of complexity. Filings from the last quarter show a major increase in institutional ownership, with firms like Vanguard and Hood River Capital Management significantly increasing their positions. This suggests that the smart money, who often have a longer time horizon and a deeper understanding of government contracting cycles, is backing the long-term vision despite the current lack of profitability. They see the potential for a systems of systems architecture, integrating autonomous platforms, sensors, and secure communications as a necessary technological leap for defense and critical infrastructure. This is a point of departure from the typical retail self-investing mentality that focuses purely on the quarterly bottom line. A brief review of the company structure highlights this strategic approach. Ondas Holdings operates primarily through two segments, OAS, or Ondas Autonomous Systems, and Ondas Networks. OAS is the high-growth, high-profile side, focused on drones and counter-UAS systems, including subsidiaries like American Robotics and Aero Robotics. Their Optimus system, the first U.S. FAA-certified small UAS for automated aerial security and data capture, and the Iron Drone Raider, an autonomous counter-UAS platform, form the backbone of their autonomous offerings. Ondas Networks, on the other hand, provides FullMAX, a software-defined wireless broadband technology for mission-critical industrial IoT applications in sectors like rail, utilities, and oil and gas. While OAS grabs the headlines, Networks provides a crucial, standards-based connectivity layer that could become the secure pipe for all the autonomous data, offering a more stable, albeit slower growth, foundation. Past performance shows massive revenue growth in OAS, exemplified by the Q2 2025 revenue jump of over 500% year-over-year, driven almost entirely by the autonomous segment, which had a $22 million backlog at the end of that quarter. However, this growth has yet to translate into profitability, and the stock's 52-week range from a low of $0.57 to a high of nearly $11.70 tells the story of an extremely volatile early-stage growth company whose fate hinges on execution and contract scale. This volatility is precisely why investors using platforms like Robinhood for quick trades or those engaging in Fidelity Trading Platform for more serious online investment must understand the underlying business model, not just the stock chart. Moving into the future outlook, the expectation is that Ondas will continue to burn cash as it scales up its production and integrates its acquisitions. The reality, however, is that several catalysts are lining up that could significantly alter this narrative. The most immediate is the Q3 earnings report on November 13th. Analysts expect a loss of 5 cents per share on nearly $7.4 million in revenue, a nearly 400% revenue jump year-over-year. The crucial metric here won't be the headline loss, but the guidance and the backlog figure. If the backlog, especially in the OAS defense and security segment, shows a substantial increase, it will validate the recent acquisitions and partnership with Palantir Technologies, which is designed to provide the scalable operating platform necessary to handle large government contracts. A substantial backlog increase, even with continued losses, would exceed expectations and likely send the ONDS stock higher, because it translates into future high-quality revenue. The market is willing to tolerate losses for secured, massive top-line growth. Beyond earnings, the Interactive Brokers and Fidelity investment community should be watching the deployment of Ondas Capital. This new entity is set to deploy $150 million to accelerate the global scaling of unmanned and autonomous systems to allied defense and security markets. This is essentially a corporate venture capital arm designed to fast-track the adoption of Ondas' own platforms and create a powerful ecosystem. This is a brilliant strategic move because it uses capital to create demand and infrastructure for its core products, effectively accelerating its own growth cycle. The defense sector is increasingly moving towards a buy-not-build model for specialized technology, and Ondas is positioning itself as the key consolidator and system integrator in the U.S. and allied defense apparatus. This is an angle a casual investor might miss, viewing it just as a tech stock, when in reality it's a strategically invested defense system supplier. The integration with Palantir's Foundry platform is another major de-risking factor. It addresses the critical military requirement for scalable, secure, and data-unified operations, which is often the biggest hurdle for smaller tech companies. However, risks are plentiful and should temper the optimism. The high level of share volatility, as seen in the wide 52-week range, indicates a lack of stability that would make any intelligent portfolio manager cautious. The reliance on capital markets, as evidenced by the shelf registration, poses a constant threat of dilution, which could cap upside gains even on good news. Furthermore, the defense technology space is highly competitive, with larger, better-funded companies like Lockheed Martin and Northrop Grumman increasingly entering the drone and counter-drone markets. Ondas needs to execute flawlessly on integrating its acquired technologies and securing these large multi-year contracts to justify its current valuation, which is trading at a high multiple to next year's sales. The geopolitical environment, while currently favorable for defense spending, is unpredictable. Changes in government priorities or a sudden end to regional conflicts could quickly deflate the demand for their specialized security systems. This is where investors using SoFi Invest or similar investing sites